45 or are we going for 45 or a full hour?
45.
Okay, sounds great.
Thank you. Okay, cool. Hey, good afternoon, everybody. This is Sherry. I'm your host for today's Trader Exclusive Strategy Series. And we've got 3 experts today for our first free live event of the year. And a few of the things they're going to talk about are how callers work to help protect portfolios. That's intriguing. How to choose the right pick to trade gaps and be done by 10 a.m. in the morning. And 10 key steps to identify leaps opportunities. Now that's just a few. I took one bullet from each speaker. Please check out tradersexclusive.com where we regularly post articles and video clips with valuable trading tips and techniques. That's also where you're going to find a recording of today's webinar. And you'll also get email from our speakers. Before we get started, of course, I have to do the famous disclaimer. You should carefully consider whether trading is suitable for you in light of your circumstances, knowledge, and financial resources. You may lose all or more of your initial investment. Opinions, market data, and recommendations presented here are subject to change at any time, and past performance is not necessarily indicative of future results. So please take notes, and if you have a question, and I hope you have lots of questions, give it a little context so we can remember where it was, so everybody gets the context. But hold them until after the options professor is done with his presentation. So with that.
Oh, one last thing. I'm supposed to be sharing my screen.
Yes, I'm going to make you the presenter now.
Okay, but I mean, how do I share the screen? Do I have to hit a button of some type?
Yeah, just a second. As soon as you're a presenter, you should see the option to share your screen.
Right
Did
here.
a little box just pop up?
Okay,
cool.
Let me just reduce the screen because sometimes that's an issue.
So let me introduce him, the option professor of optionprofessor.com. He's going to talk to us about how options can reduce risk and protect portfolio values. The option professor is a graduate of Boston College and Don Bosco Prep and received his options training at the Chicago Board Options Exchange and major investment firms. He has traded thousands and thousands of options contracts and has educated thousands of investors worldwide on the uses and risks of options. I'm really, really happy that you've decided to join us today, and take it away.
Sure. Okay. Again, I'm the option professor, and as we just said before we got started, make sure that you understand that I am going to be sharing my opinions and my observations here today, and that everything you should do should be consulting with your brokerage firm to find out what your risk tolerance and your suitability is. What we're giving out today is not advice on anything specific, but I'll give you the best information I can, and here we go.
Now let me just check with you, because all I can see is your go to opener screen.
Oh, okay.
You shared the right screen. You may need to pick. How many screens are you working with today?
Just one, and the one that I'm on.
Okay.
So if I hit go to webinar again, this session's already running, so I'm closing. Yep. Is there any other, because I hit the thing about sharing the screen. Is there any other thing? It says show, stop showing screen. It says, oh, show screen up here.
Usually it will ask you. Yeah, usually it will ask you, but are you running PowerPoint or anything?
No. I just have I have 2 screens. One screen I'm trying to show you.
Okay.
And
so you do have 2 screens. So what you're going to need to do is,
okay, here I go. It says screen monitor 1. I guess I have to hit screen monitor 2.
Yes. And I usually use it clean. I don't know what the difference is, but I like the sound of clean, you know what I mean? But it looks good. We got it now. It's a bar chart, right?
It is.
All right.
There
I'm
you
going to
go.
stop talking and let you take it away.
All right. All right, guys, thanks for hanging with us here as we get through the technical difficulties. We'll go from there. But again, getting back to the point here, I'm going to be going over a number of things because I've been doing this for such a long time and I work with a lot of money in the market. So basically, I'm going to go over how you can reduce risk and protect your portfolios with options. And then in the second half of the broadcast, I'm going to go over some of the things that I'm doing here and that are available through my Collective 2 account that have been doing very well here today. Despite the markets being down, you'll see the stuff that I'm talking about is doing quite well. So that's we're very happy about that. Hopefully it continues, right? Okay, so let's start out with the basics here of what we're going to try to do. When you have a position on and the market has gone up for you, or even coming out of the box, you may want to put parameters around your equity, meaning an upside maximum and a downside minimum of what that position will go to. And that's called basically a collar, which I'll get to in a minute. Then basically I'm going to be going over replacement trades. You know, when you get a big run up like in NVIDIA or something, you may have a very large gain in it. And you may say, I'm going to take my money off the table, but I want to stay with the market. So you use options to replace the underlying position, which means that your risk, your cash risk, is going to be much less because all you have is an option premium at risk, not the entire stock. I'll cover how that works as well. Then, of course, when do covered call writing, when does it make sense? When are the probabilities, in my opinion, are best? I'll go over that. And then basically married puts. If you have such a big gain in a stock, throwing a little bit of insurance money at it is probably not a terrible idea. And then finally, I'll go over legging into call and put spreads to hedge your risk, meaning a lot of times you hear unusual option activity, and you'll hear that they're all buying the XYZ call on XYZ expiration. Well, sometimes what you might want to do is buy a lower strike price than the call that they're buying. And if they're so correct on the one they do, you can sell that one after a little bit and you get a free look at a call spread. I'll explain how that works as well. Like I said, I've been doing this for decades. This is a second language to me. And so bottom line is I'm familiar with all the different strategies, and I have my opinions on when they're effective and when they're not. Okay, so let's start out here, and I'm going to use Apple as a basic stock because everybody knows it, right? And everybody obviously must own it because it just hit $3 trillion, right? But again, another thing that I know that people may not know is that after Apple has gone through their $1 trillion valuation and their $2 trillion valuation, and they just went through a $3 trillion valuation, they sometimes have a pretty good sized pullback. And today you are seeing that it is pulling back off those highs. So that's interesting. But anyway, let's use Apple as a model because it's familiar to everyone. Right now, you can see Apple's trading about 178 bucks, right? Okay. All right, let's say you bought Apple at, well, I mean, you know, you could have bought it all year long here when you could have bought it in March for 116 bucks. You know, you could have bought it, let's see, no, well, that's last year. Okay, so in March, in the first quarter, you could have bought it as low as something like 120 bucks. Now it's just run to about 180 bucks. What's the highest on it it's been? Let's see, the high's been about 183. So, you know, obviously if you buy something for 120 and it goes up to 183, you are up $63. $63 divided by 120 where you started, you're up 52% on your money. Now, come on, that's a pretty good size run. So what a holder of that stock may say is, come on, we just had tremendous amount of news on it. It's the first quarter here. Some people think that there could be some kind of volatility on the horizon, simply because obviously the stimulus is being withdrawn and the GDP may slow down a little bit. And this Omicron thing might be a little problematic. And so it would not be unheard of that it could have a pullback. The other reason that you might think there's a pullback is you see my moving averages, the 12 SMA, the 24 and the 36 are way underneath the market. Now this is on a 20-year graph. Let's go to a 5-year graph. And they're still pretty far underneath. The blue's at around 150, underneath 150, and this one's here at 160 something. If you go to the 1 year, you can still see that obviously it's tugging on to the 12 SMA, which is 177.5. So it's trying to hold that. If it breaks that, you could go under 175. And if it goes down for a more significant correction, you could be at 170. What could happen here is a situation where the market may have some trouble up here. So what you might look, because obviously when the market's rallying like this, the call premiums are pretty heavy, right? So say when it was at 180 or better, and it's in the news that $3 trillion market cap, and it's just fantastic, you know that the call buying is probably pretty hot. So in this case, what you might do is it's at 180, you might say to yourself, I'd like to give myself a little bit more room. So I'll sell a call at 190, or I might sell a call at 195. That still gives me more upside to 190 or 195. Now, whatever that premium is that you receive, because if you sell a call, you're receiving a premium because you're agreeing to deliver or sell your stock at the strike price you choose. So if you choose 190, you're agreeing to sell at 190. If you sell at 195, you're agreeing to sell 195. You take that premium that you just received for making that agreement to sell your stock, and you buy a put option. And let's say you sold the 190 and you bought, say, the 175s or the 180s. Well, what happens there is if the market does drop down to 150 or 160 on a correction, you've got the right to sell at, let's say, 175. And so you've got parameters around your stock at 190 upside potential if you sold the 190 call, and a 175 put would give you a floor on your stock at 175. So if it drops down to 150, your stock that you own has dropped, what, $30? But you've got a put at 175 that's worth 25. So you've offset quite a bit of that risk by doing this strategy. Again, a collar is generally used for people who want to put parameters around their equity. They want to have an upside, but maybe they are satisfied with the limitation. But more importantly, they're trying to make sure that all this equity they got in there has some kind of insurance on it in case it rolls over for whatever reason. Again, sometimes markets roll over for reasons that are not, that come out of the blue, and they sometimes roll over very quickly. So having a preset insurance on there sometimes can make you sleep better at night by a lot. Now, again, what time frame do you put the collar on for? That's a personal decision based on whatever you think. If you want a longer term protection on it, obviously you put on a longer term collar, meaning 3 months, 6 months, whatever you want to put on it. And then also you can adjust these positions as they mature. So in other words, obviously, if we drop down towards 150, you may take off your put insurance there, and then maybe have no insurance because you think it might stop 150 because you can see the blue line's been pretty good all the way since the bottom. Okay. On the other hand, if it starts taking off and you think there's a lot more potential above the 190 strike, you could buy back the call. You might have a loss on that. Maybe you sold it for, just using a theoretical example, you sold it for 3 and you got to buy it back for 7. That's a $4 loss. But again, the stock is up another 10. So that's 10 minus the 4, you're still net ahead. And then maybe you'd sell the 200 calls and try to make the loss back of the 190 at the higher strike at 200. That's called a rolling up the position. So again, you can start out and just leave it alone, and then the original risk will remain until they expire, meaning the opportunity risk above 190 and the insurance of 175 if you bought the put. Or you can adjust it as it moves around. And those are your choices. But a collar position come in very handy because, again, if you collared it at 145, you got a chance to go back in here at 120. If you collared it up at 160, you had a chance to come back in at 140. Okay. Now, like I say, if you have 1,000 shares, or more, that's a 20 grand drop. And that's going to be, again, about a 25 grand drop in your equity. So some people like to hedge that a little bit. The other thing, like I say, you can do covered call writing. And that's just where you sell the call and you still own the stock. You don't have any insurance on the downside. You're just trying to create cash flow or income by selling the calls above the market. And then, of course, if the market drops more than the premium you took in, let me give you an example. If you are in the stock at 180, 183, and you sold the 190 call for 5, that's $500 credit on every 100 shares. So if this thing goes from where you did it at 180 underneath 175, that premium you took in was protecting yourself down by $5. Anything under 170, your equity again would be decelerating. So basically, again, going to this thing here, when does covered call writing make sense? In my view, my opinion, it's like anything else you sell. I mean, if you want to sell real estate, would you want to do it now or during the recession of 08? You want to sell things when people are what? Buying them. And if you're agreeing to sell your stock, the highest strike price you can get is, a better deal. In other words, if you sold calls at 150, you missed, you capped your gain at 150, you've missed out on $38 of, or $33 of movement. If you sold calls at 130, you missed out on $50 of movement. So where you sell them is very big. Now, right now, we are at a fairly extended area. And we've seen from when they get extended, they come back to the mean sometimes. So if this thing is going to come back to the mean at some point and not go any further than 190, this is a time to entertain that. And again, you're not locked into that forever. You can buy back the call and that cancels the deal, plus or minus whatever you sold the call for. Okay. And again, some people like to roll it up. And that means that, you take a loss on the 190 if it goes up here. And if the loss is like 3 points and you can sell the 200 call for 3 points and it doesn't go to 200, you can make up that differential by selling the higher call. If it keeps going, obviously you may either have to take a loss on the 200 call or roll that up as well. But in my view, my opinion of decades of experience, you want to sell calls when the market's hot, because that's when you're going to get a high price on your strike price, and that's when you're going to get a large premium for when you sell. These people that go around selling premiums for 0.25, hoping it goes to zero, and 0.20, hoping it goes to zero, and then they annualize the return if you were right on that 52 weeks in a row. That's a game, but that's a game that seems to me like picking up pennies in front of a freight train, because when you're picking up pennies and your risk is way bigger than that, you've got to really be careful when you're wrong, because you can't afford to take a big loss when you're selling premiums for very little premium. If you keep selling them for 25 cents and then you take a $5 loss, you don't have to go to Harvard to figure out that math doesn't work very well. So in my view, if you're going to sell calls, you want to sell into big strength and you want to sell when the premiums are very fat. Okay, so that gives you a couple of ideas on hedging using collars, which is the simultaneous selling of a call and buying a put, and also just a straight selling of the call. With regards to put selling, which is another strategy that makes a lot of sense during certain environments. For instance, if you're going to sell puts, you'd want to sell it when something has dropped and when the premiums are very large. Why? Because when you sell a put, you're agreeing to buy stock. Well, you want to buy it at a low price with a lower strike price, right? And you want to get well paid. When are people buying a bunch of puts? When the markets are tanking. How do you know when it might be time to look at that? The VIX is not a bad thing to look at. And of course, the charts. And when the VIX jumps up to 25 or 35 or even above, that's the time to start investigating your put selling. When you sell a put, you are contracting to buy the market. If you don't have money to buy the market, don't do it. If you don't have an interest of buying the market, don't do it, because that's what you're signing up for. A selling of a put is agreeing to buy the market at the strike price till the expiration, and also less the premium you received. So for instance, selling puts, when you see a market like Apple go from 150 down to 120, and you see it against the blue line, you might start looking at the 110 puts or even the 120 puts at a big fat premium, okay? And then if they don't go down to your strike and the market rises, you get to keep the premium, but you don't get any stock. If you want to protect yourself against an up move, you kind of do a reverse collar. And here's how that works. Say you sell the 110 or 120 put when it's testing this line, right? And then you get a premium. So you take that money you receive by selling the put and you buy a call. And say you bought it at 140 after you sold the 120 puts. That means you have the right to buy Apple at 140 until it expires, and you've agreed to buy it at 120. So your parameters are 120 or 110, whatever strike you pick, and now you've got the right to buy it at 140. You don't get any stock put to you underneath? That's okay. You use the premium to buy the 140 call. Now the market is up at 150. So that 140 call is worth 20 bucks. If you bought time, let's say you bought a 6-month deal, then you could be in there for the further run. Or you can what they call roll the position out, which is here. I'll give you a for instance. I sold the 110 or 120 put and I won the and I bought the 140 calls. The market jumps all the way up here to 160. I sell out of that call that I bought at 120. The put expires worthless. Now I took my money off the table. It comes back down to the line. I do the game again. I sell the put at 130. I buy the call at 150. Now the market goes up to 180. I got the right to buy at 150. Now that one's 30 bucks in the money. And what I would be doing right now is either A, getting out and taking my money off the table, or B, getting out, taking my credit, and if I'm afraid of it continuing to move, I would buy the 185 call with some of the proceeds, or I'd buy the 185 and sell the 195 just in case it's going to go on one more leg up. That's only if I'm in this position where I just I'm afraid of being out of the market. Okay, because I think this thing's just going to keep going. Right now, that's not exactly what I think, but it could. So anyway, there you're getting a few ideas on how to use options defensively and offensively. And again, it's something that you don't do constantly. You kind of put the strategy in when the game situation sets itself. In other words, I'm not selling puts up here at 185. Okay, no way. Why is that? Because it's extended off the moving averages. The puts are probably pretty darn cheap because the market's way up. And I don't want to get put stock with on a pullback to 160 up at 175 or 180. Okay. In my view, probabilities are not favorable right now. That's not the play I would call based on the game where it's being played right now. Okay. So again, if anything, you'd have to do spreads up here because the premiums are pretty big. So if you had to be in this thing for whatever reason right now, spreading it would make the most sense. And the other thing that would make sense is buying some time. So if you did have a situation where you wanted to, another way of doing it, this is called a replacement trade. Okay, and we were supposed to go over that. So let's go over that right now. You bought the stock at 130, 120, whatever you bought it at. It's up at 180. Okay, you got a pretty good gain in there, and maybe you want to grab some off the table, but stay with it. So you replace your position with options, and here's how you do that. You can either you've got a if you bought here, you got a $40 gain. If you bought here, you got a $60 gain. $40 or $60 a share. Okay, you want to lock some of that in. So you lock some of that in and you take some of that money, the $40 or $60 gain, and you buy a call spread. And you buy a call spread by buying something like the 180 call and selling the 200 call, or the 185 call and selling the 200 call. Give yourself 10 or 15 bucks or 20 bucks of potential gain if it's going to keep going. But what you might do is buy some time so that if the market gets rocky in the short run, okay, you have the ability to not expire. In other words, the big problem when on the long side of options is expiration. Once they expire, they're done. So if they expire out of the money and they go to zero, that money's gone forever. If you bought time on your spread and the market has a tough time in the short run, sure, your options will be down in value, but if they haven't expired, you're still in the game. And if the game has still got this blue line rising and rising and rising, there's a reasonable expectation that maybe you'll get another rally. But you have to make sure you bought enough time to accommodate corrections. Good case in point is if you bought calls right here in January, okay, and you bought a 9-month option. Some people like to buy long-term options because of the Black-Scholes time decay is very much less on 9-month options than they are obviously on 1 month. These 1-month options, the time decay is going to be extremely rapid because obviously there's no time left on it. So if you bought a long-term spread in January, right at the high point for September, and the market goes down for all this time, well, you can see by September it was back up, or by August it was back up to 155. So you could have been wrong on this thing for 8 months, right? And still come out with some money because, again, you bought time. So that's a good example of why when you're buying options, you tend to want to buy time. And when you're selling them because you want the premium to go to zero, you want to not sell time. You want to be in the 30, 60, 90 days area so that the time decay will work for you the most. Using your common sense, if somebody's got a 9-month option and things go against them, are they going to sell out necessarily? Probably not, because they got a lot of time on the clock. So the premium, the time value, is probably going to hang in there pretty well. If you are in the 1 week, that's why you hear all these options, 1 week, this guy's doing 2 weeks, 3 weeks. Those are going to be fantastic options on the buy side if they work, because they probably don't have much time premium. And therefore, if you catch a move, you could do pretty well. They're also extremely risky because if they don't go right up, you're going to lose all your money pretty fast. So again, short-term options lose their time premium very quickly for obvious reasons. With regards to your choice, obviously everyone's got their own way of doing it. I see on the news broadcast that unusual option activity is going on, and they're buying something that expires Friday. Well, I mean, that sounds like a black or red deal. It's either going to happen or it's not. And sometimes, obviously, it does happen, and it's a fantastic thing. But when they don't, your equity goes to zero, and that equity's gone forever. Okay, so let's talk a little bit about legging into something that, say you are a short-term trader, okay, and you want to do a very short-term trade. I heard on the news something on the Gap stores, and they said there was a lot of activity in the February 1850 calls, okay? So just using that as a theoretical example, but it's something that I heard. Let's just take a look at it and see a couple of ways to play it, okay? So basically the action was on the unusual action, and that just means volume is very, very big in that particular series. That's what unusual activity means, okay? It doesn't mean they're right. It just means that there's a lot of activity. Okay, so right now, you can see that the stock has very much been down. It's very oversold. So anybody who's buying a ton of options on this is basically looking for a reversion to the mean type activity. So let's go into a shorter term graph. That gives you an idea how far oversold it is. And let's just say, let's just look at the Fibonacci setup. It starts at 6, it goes up to 38. That's $22. 61% is 13 bucks. This thing has gone way down more than 16 bucks off the high. Yeah, it should have stopped at 22. It didn't. So anyway, that's not helping you very much. Let's go to the 1 month graph. You can see this thing gave a buy signal on this on the month at 16 bucks. So if you're using the short-term graphs, you should have been in this thing at 1680. Should be all over it, or you should be just enjoying the ride. If you go to the 1 year, this thing gave you a buy signal on the 12 when the 12 crossed the 24 at 17 bucks. Okay, so when this thing got its unusual activity, I think it was trading at around 18. So if the guys are buying the 1850 calls, right? An idea that people sometimes do is rather than buying the 1850 where the unusual activity is, they'll buy the 1750. Okay. And then when they buy the 1750 calls, let's just use theoretical numbers. The market's at 18 bucks. Let's say the 1750 calls are going for, well, they're in the money by 50 cents. Let's say they're relatively short term. So let's say they're going for $1. And the 1850 calls are going for 50 cents. Okay. The idea here is that now the market's at 1873. So these 1850s are in the money. You bought the 1750s for $1 in this theoretical example. Now that we're at 1873 and the volatility is picking up, 1882, maybe the 1850 calls are now going for $1. Okay, well, as an example, You bought the 1750s at $1. Now the 1850s are at $1, and now you can sell the 1850 for $1 to get your dollar back you paid on the 1750s, and now you've got a free look at the dollar spread there. So again, if it goes down and collapses, the dollar you collected on the 1850 paid your 1750, so you're out of no money. And if it keeps going, you have a limited gain of a dollar, $100, but that $100 is risk free at this point because you've got the spread in. So that's called legging into it. So there'll be many examples of when you see this type of activity where you see unusual option activity. And one way of trying to play it a little bit more, shall we say, interestingly, is to take a lower strike than where the big volume is, and then leg into selling another call at a higher strike if the stock starts going. So, this thing's at 1883 right now. You don't have to sell the 18 and get out of it. You could maybe sell the 1850s or the 19s. You could let it ride a little bit, and then basically you could leg into it to get your money out anytime you want. But the bottom line is, let me give you, for instance, if the stock goes up to 20, okay, and you sell the 20 call for $1, and you bought the 17s for $1, now you got a $2.50 profit with no risk because you sold the out of the money call. So legging into this thing is a very, very interesting way to do it, because it's a way to put your foot in the water with some risk capital. That's what you did when you bought, in this instance, a 1750 call, a theoretical example here. And you just sat back and you're watching this thing go. And now it's at 1883. So you want to take more risk, you stay in there and you see if it'll go further. If it jumps up to 20, you can take a look at it. There's a gap here up 22, 23. Maybe it's on its way to 22. And if it's on the way to 22 and you sit tight on your 1750 you bought for $1, and then you sell the 22 call for $1 on a big rally, now you've got a almost a $5 potential gain on $1 risk. And once you sell that out of the money call for more than you sold the 1750 for, you lock in a profit. So, hey, there's a lot of ways to do the options, and there's a lot of ways to offset risk you take when you buy or sell them. Spreading them, legging into them, using collars, using married puts where you simply buy a put against your stock. A lot of different ways to go. And at optionprofessor.com, and Option Professor, there'll be some contact information after we're done. If you have questions on anything, I'm more than happy to help. We're not giving advice to people. We do have information and knowledge. We'll share our opinions and our observations. But like I say, we don't give advice. Okay, so there you go on giving you a little bit of idea on that. Okay, I've got about 15 minutes or 10 minutes to go. I'm going to go over some of the stuff that we're focused on that is available for viewing for people, and we'll explain that at the end of the broadcast as well. But we're having, I think, a bit of a down day. Let's take a look. There we go. Okay, not too much, down just a little bit. Okay, if you look at your QQQs, I think they're getting whacked a little bit harder. Yeah, okay, they're down a little bit harder. Okay, in fact, they look like they're breaking down a little bit. Okay, what's the reasoning behind this? Obviously, when you withdraw stimulus and the 10-year note jumps up towards 170, where it was at 150 a week ago, obviously that gets people who are into high multiples and high growth rates a little bit nervous, and people who put new money in the market are not trying to just gamble. They're trying to hopefully get a dividend, and they're hoping to get a valuation on a stock that is reasonable. So here are some of the things that we have been focused on that seems to be doing pretty well. And so you can see the markets are all down. One thing that we've been involved in is energy. And you can see energy has been a very good place to be with the start of the year. That's what we've been focused on. And we have individual stocks that we like here that we put on our account that we have, that you have access to. So we have individual issues, and there you go. That's a sector that we're in. Next one here is financials. And again, energy has structural shortage. You know, these guys are returning all their capital to what? To shareholders through what? Buybacks and dividends, right? And these guys have got tremendous free cash flow. Free cash flow. So that means they've got a lot of money coming in. And every time you see crude go a little bit higher, they got more money coming in. So the bottom line is that's why the energy sector is something that we have directed our attention to, and people who follow us are well aware of that. Okay, the next area is its financials. Again, when rates go a bit higher, it allows banks to make more money, right? Right. And so we were well aware of that. And so we have been in this sector as well. You can see it's doing very well. We also have individual financials, individual stocks that we are keen on, and that is a sector that is doing very nicely for us, while other sectors are losing. Right? Right. Okay, next one is base metals. Okay, you know, if you notice things that have some type of uh, quantity limitation, you know, that's the whole thing about Bitcoin, right? There's a limited quantity. That's why people think it's a store of value. Well, you know, there's not unlimited metals out there either. And so this is base metals, and this is your steel and your nickel and all that kind of stuff, and your copper. And so you can see this has been a fantastic place that we have directed people towards as well. And we have individual issues within this sector that also have done fantastically. So again, there's another one for you that we're keen on. Another one that we like that has been very good for us has been things that pay dividends. And you'll see that is another sector that is getting a nice bid. So you understand why we've been involved in these as well. So that is another area that we have liked quite a bit. So again, those are a number of the sectors that we like and we think have got a lot of potential in the year ahead. And obviously we're not in a party of one, because it's a situation where you're seeing quite a bit of money going in that direction. So we are trying to use our common sense, and we are trying to let the charts tell us what to do. Obviously, these charts have been telling us to get in, and that's why we're in. Some of the ones that could be fairly good a little bit further down the road is the semiconductors, because obviously the need for chips is not going away, but they are pulling back now. So this is an area around 305, and I look at the 5-year graph even more. I'll give you a neighborhood. The first stop will be right around 300, and then 280. So if we can hold the 300 area, that would be good. Again, this is one, though, that has the higher valuations sometimes, like your NVIDIA and things like that. So that is sometimes problematic. A couple of other areas that have been very good to us is in the automotive area. And this is going to be one that is also something we're very keen on. This would include all those car companies that are dealing with the electric transfer, and also some of the charging situations as well. So this has been an area that's been very good for us as well. And that, of course, is your electric vehicles and basically your vehicles in total. You know, you don't have to be in 19 sectors that work. You just have to be in a handful of them. You want to be in the right sectors and the right stocks, obviously. And so, you know, some stocks are a better time to be involved than others. Obviously, tech and growth right now are having a little bit more trouble because, again, they are not so keen on the 10-year note going up so high so fast. Also, we got an unemployment report on Friday, And when that comes out, if it comes out hot like the ADP report just did, that's going to be a little bit more fuel on the fire for the 10-year. Again, 175 has been the high on the 10-year since March. Last year, we believed that would not get taken out, and it didn't. So things that were interest rate sensitive, that rates would be lower, they did pretty good from March until the end of the year. That means TLT and things like that. But we can see that the mood is changing a bit, and we can see that the futures are going significantly lower in some of those. So we see that there could very well be a breakthrough 175 this year, particularly if these numbers remain hot. But that doesn't mean stocks are a bad deal. It just means you have to be in the sectors that actually don't mind the rate going up. And those are the ones that I've directed you to this morning that have been working for us so far this year. That doesn't mean tech and growth won't work out for the whole year. It just means temporarily they are going to be having some trouble. We always believe in the barbell approach, which means what? You have a little bit of all this different stuff, and then you trim and add, trim and add, trim and add throughout the year. Right now, adding to value, dividends, cyclicals, that's where you want to be, adding and being in more heavy. You want to have trimmed out of some of the growth and some of the tech. That doesn't mean you can't add to those at any point in time, but right now they're on the defensive. When they're not on the defensive, we'll add to them, but not while they're on the defensive. Okay, so let's just see if there's anything else I could cover here. Yeah, one other thing that's starting to happen here is overseas. Europe has been pretty much shut down, right? Well, they're already getting more like us as opposed to where they're having trouble. I'll show you the difference here. It'll be very easy for you to see. International investing. This stuff here looks like it wants to go higher. This is a Europe ETF. Obviously, you can break down by going to their top 10 holdings and see which stocks seem to be going. But again, why would this get going? Simply because what? By the time next spring and summer comes, they're expecting these guys to open up. When they open up, they're going to get a lot of tourism. They're going to get a lot of action over there. And that could be this is almost like a reopening trade. So keep an eye on this because this could be a big winner for next year. Other things that we have been pointing people to as a reopening situation, MGM Grand. Been very good above 40. It's been doing very good. We want it to stay above 40. See, right as soon as it got above 40, it was looking pretty good. We'd love to see it start trading above 50. That may happen if we reopen as we get into the summer. The airlines, obviously there's individual stocks we work with within here. I'm just showing you the ETF. Airlines, again, still looking kind of tough right now. So again, until they get above 24 here, it could still be tough for the airlines. But you would think by next summer, things could be way up here in the 28, 32 area if it gets going. Same things with vacations. And this is one that is also trying to get going. This is Hilton Grand Vacations. Again, a great play for next summer possibly. And when people want to go someplace, they definitely have to make reservations. And so here's the reservation stock that we've liked, although it did get extended and it's probably going to pull back. But you see, this thing looks like it wants to go someplace as well. So that gives you a little bit of a reopening situation. Okay, it looks like I've got about a minute to go if my timing is right. So I would like to close by just saying thank you to everybody, and also to obviously let you know that at optionprofessor.com, you can put your email in, and we have 3 types of collective 2 accounts. One is called stocks, bonds, and options. The second is called swing trading, and the third is called commodities and crypto. So you have 3 ways to access what we're looking at, what we like, what's in there. And by going to optionprofessor.com, you can learn more how to gain access. We try to do our very, very best to give you ideas. Yeah.
I was just going to say, I just put your link in the chat. You just have to copy and paste it. I didn't put it in the HTTPS. Is there any special link they need to go to, and how do they get in touch with you?
Well, again, when they go to optionprofessor.com and put their information in, we do contact them and we explain how to proceed from there after we talk to them and find out where their interests are. because not
Okay,
everybody has
cool.
the same interest. So obviously it's not a one-stop thing, because some people have no interest in crypto. Some people would love to know about swing trading, and different things people want.
Excellent. Thank you so much for being with us. And that's just perfect. We're right at 1:45, and I know that our next speaker isn't waiting. So I really appreciate you being here, and I hope you'll come back again.
Okay, thank you very much, you guys, and have a good luck and good trading out there.
Have a great day. All right, guys. We have up coming now is Melissa Armo. And I'm back on the disclaimer. Okay, just a second. There we go. She's going to talk to us about earning a living trading gaps in 2022. And I just want to let you know that, initially Melissa was a mortgage banker, and she changed industries to pursue a security trading career in 2008. And by 2012, she founded the Swoosh, LLC. It's an educational firm that empowers traders with a complete and detailed system to become profitable traders. And she's a self-taught day trader with over 10 years of experience. Melissa's specialty is a trading strategy that focuses on shorting stocks that gap. That's what she's going to talk to us about today, too. Melissa is also featured frequently on TV as a stock market expert. Watch her on RT America, Cheddar TV, CBS, Fox News, and Fox Business Network. And with that, welcome and thank you for coming on today, Melissa. And I'm going to make you the presenter. Now, do you like to take questions during the presentation, or do you like them held until the end?
Hi, can you hear me?
I can hear you now.
Great. You can do whatever you want to do with the questions. I can take them as we go along. That's okay. I have the chat up.
Yeah, I think you like to ask questions during there, the way you like a little interaction too. So I'm going to change you over to an organizer, and I'm also going to make you the presenter now, and take it away. Thanks for being with us.
Okay. Can everyone see my screen?
I can see it.
Wonderful. Thanks so much for that nice introduction. Welcome, everyone. Hope everyone is having a wonderful day. It is raining / snowing a little bit here in New York City, so it's very, very cold. So it's nice to be indoors, trading, talking, doing all the fun things that we do as traders. So I am going to talk to you today about how you can earn a living trading gaps. So I trade gaps. That is all that I do. I don't do anything else whatsoever at all. Now, I do trade gaps as options, and I also trade gaps as day trades. It really has to do with which one you prefer. My strategy is based on gaps no matter how I play it. So for example, some stocks, I trade the US stock market. Everything I do is in the US stock market, which is open from 9:30 to 4 o'clock Eastern time. Some things make more sense to actually trade as an option. For example, something like Amazon, or even like Tesla or Google, stocks that are very expensive, where they're very spready or very expensive. It makes more sense to trade them as options. But I do both in some stocks. For example, the market, the QQQs, Boeing is another one we do a lot. I will do it as an option and a day trade as well. Now the market is falling today. The market gapped down today. We'll look at the market live if we have time here at the end. So I'm going to start the presentation, but the market did gap down today, and you could have shorted the market today out of the gate, or you could have done a put, which is basically a put in an option. So I just having this up here. If people do have questions, you can feel free to just plop them in the room, and I will see them as we go along. If you also have questions, that's me, by the way, you can email me at melissa@thestockswoosh.com or call me at 929-3200-GAP. You can also follow me on Twitter, Facebook, YouTube, or Skype. I try to put when I'm on television there. I am on Cheddar TV at 4 o'clock today. Tomorrow I'm on Ameritrade, and Friday morning I am on Newsmax, if you watch Newsmax TV. So I'm talking about this whole week on television, the sell-off in the market, COVID, what is happening. I heard the previous speaker was discussing, Europe and the shutdowns and this, that, and the other thing. New York City right now is in this weird place where we're not fully shut down, but a lot of businesses and a lot of offices have shut down. So it's not like a citywide shutdown, but a lot of companies, corporations have said, don't come into the office because of all the cases. So that is one of the reasons, again, why the market is falling in the last 2 days. So let's talk in general here about gaps. Why trade gaps? Well, gaps are something that happens on a regular basis in the market. So as an active trader, I'm an active trader, which means I'm looking for trades Monday, Tuesday, Wednesday, Thursday, Friday. I'm always trying to find a move in something. Now, I prefer to do only one trade a day. That's really all you need to make money. But there are so many stocks and so many things that gap on any particular day. It's not hard to find something each and every day. So again, if you're looking to trade and be active, you've got to find something that sets up on a regular basis. That's very, very important. You also need results if you want to make money trading. Again, we're talking about doing it for the whole year, to do it as a job, to do it as a career. Well, you need to make money to do that. You need results. And I think a lot of people want to trade, they dream of trading, and they tend to start out with a very positive attitude, an optimistic attitude, and then they go negative. Why? Because they start out, they trade, they lose, and then they feel like, oh my God, this is impossible, I can't do it. Well, you've got to find a strategy. That's number one. And two, then you have to have a strategy that gives you the results. The results, I mean, I don't trade penny stocks. I don't trade low float stocks. I don't trade things that have no volume. Very difficult to make money or make money on a consistent basis when you're doing stuff that hardly moves. Everyone's all into these Reddit chat rooms now and the whole Reddit phenomenon. I looked at GME the other day, which is what started that phenomenon at the beginning of 2021, if you remember all of that, going back now almost a year. The stock's falling. In fact, I didn't look at it today. I'm sure it's falling today because market's falling today, but so many people are tracking that long. You can't do the same stock every day either. Okay, so I do a different thing all the time, every single day. I never know what I'm going to do until I get up in the morning and I see the gap. And again, I'm going to explain to you and teach you here today what a gap is. All right, but you've got to have results in order to do this for a living. Otherwise, how are you going to pay your bills? You have to find a way to do it. So this was, my assistant put this in here. I should have had him put a December in here as well. He did this webinar for me a couple days ago. This was the results for November. We had a big month. Now, November was earnings season. Earnings season for first quarter 2022 begins when? After Martin Luther King Day. So 2 weeks, basically 2 weeks from yesterday is Martin Luther King on the 17th of January, 18th, then we have earnings season that week. So earnings season is a very, very productive and profitable time to trade the strategy that I do on gaps. We had 16 winners, 4 losers, 2 break-even trades, 22 trades in total, and an 82% win ratio. Now, this was an advanced trader risk for these profits, meaning that the risk was about $2,700 per trade, all right, for the profits. You do not have to risk that day trading. You can risk less. You can risk 400, 500, you can risk 1,000. But either way, an 82% win ratio is really good results. So we were talking about results. You've got to have more winners than losers. I have trades that lose. Every trader does, but you've got to have more winners. So I have more winners than losers, which is how I can do it consistently and profit month over month, year over year. So let's talk about the basics here. What's a gap? What is a gap? A gap is the difference between the close and the open. Simple. That's it. Again, the U.S. stock market closes every day at 4 o'clock and opens the next day when? At 9:30. From that time period, from 4:01 to about 8 o'clock at night, and then in the morning, very, very early, sometimes as early as 4 a.m., 5 a.m., 6 a.m., stocks are moving. The market is moving. People are putting trades on and taking trades off. That is where the gap is being created in the post and pre-market, okay? So again, this is something that happens every day. So let's take a look at a chart here. This is Boeing. So this is a daily chart. So what happened here with Boeing? I'm going to go back to November, okay? In fact, I think this is falling today. We had a gap up today in this, and I think this is falling. I don't have today's day on here. I clipped this yesterday. But here was a gap down. So this is a daily chart. Okay, I'm going back here to September. This is Boeing. BA is the ticker symbol. So here's where the stock closed at 4 o'clock on one day. Closed, opened the next day here. So you see where this is. Again, hard to tell the exact number here, but this is approximately around 210. Then it opened the next morning where? Under 200. It was like 198-ish. So from here at 4 o'clock to here at 9:30, it gapped. Okay. This tail represents a selling movement in the stock. So you could have shorted it. You could have shorted it, got out, boom, and made money to the downside. That is a gap down. What about this one over here? Again, this is before Thanksgiving. Stock closed here, gap down, had a massive sell-off. Closed at 4 o'clock the night before up here, around 225-ish. Or no, it was above 225. It was around 226, it looks like, and change. Opened down here under 225 and fell. This fell more than $10. So this is momentum. This is selling, okay? And this is how you're going to make money as a trader. Again, you could have done an option in it. You could have done a put. You could have done a short as an equity trade, which is a trade on margin. And if anybody doesn't understand what margin is, you can ask me that right now too, okay? Now that is a gap down as well. This one and that guy there. Let's talk about, oh, here's another one. Let's talk about this one too before I show you gap ups. This closed here, this gap down, 4 o'clock, 9:30, boom, get the drop. Again, momentum to the downside, boom. Could have done a put, could have done a day trade short. You could have even done a swing trade in this. You see where it went, fell all the way down here. Again, this is December going into the holidays. Somebody's asking a question here. Let's see if I can blow it up. The gap happens. Somebody's asking about the hours. The gap happens at night or in the morning. That's what I'm saying. That's when it is being created. It is being made. So here in the chart, excuse me, you're seeing it, the close and the open. But trades went off here. You just don't see them here. They went off at night or in the morning. Could be both. So over here is a gap up. Closed here, opened higher. So this closed at one price and opened at a higher price. This is a bullish gap. Rally. You could have gone long. Actually, we had a gap up here. This was here closed. This opened up, rallied. You could have done a call. You could have gone long. It moved up for 2 days. Okay. So you can do bullish gaps and you can do bearish gaps. There's examples of both. So what is a gap? Let's look at Apple. What is margin? Margin is if you want to take a trade in a stock like Apple, for example. I didn't look at where that's trading right now before the lecture here. The stock might be trading, let's use an example at 180, for example. If you wanted to buy it, you don't need, say you want to buy 1,000 shares of Apple, you don't need $180,000 in your cash account in your trading account to buy 1,000 shares of Apple if you trade on margin. Margin is something that is given to you by the broker, and you can go to a retail place and get 4-to-1 margin. So you would take 180 divided by 4. That's the cash you need to take a 1,000 share position of Apple long or short. And if you wanted to go to a prop broker, you could get 10-to-1. So for example, you need 18,000 in cash to take 1,000 shares of Apple at a price of 180 if you're doing a day trade. This is not an option. You don't trade options with margin. It's only the cost of the option, whatever it costs you. But when you day trade, an equity trade, you are trading on margin, which means you're in and out between 9:30 and 4, and you got to be flat by 4 o'clock. The broker gives you the buying power based on your cash position. Does that make sense? That's what makes it possible for people like regular people to actually trade without hundreds of thousands of millions of dollars, actually. So that's really a positive thing, actually. Let's talk about Apple. What has it got? What happened with this guy here? Let's go back. Closed here, gapped up, rallied. You could have gone long here, Apple. Again, this was back before Christmas. What about this over here? This has had a lot of gap ups. Look at them all. This has been strong, very strong. Again, this is probably falling today. I didn't look at it, but I'm sure that it is with everything else. This closed here, gapped up, rally, closed here, gapped up, rally, closed here, gapped up, rallied. Look at the beautiful move. This was the beginning of December in Apple. Okay. Here's a gap down. So this closed here, this gap down fell. That was back in November. So a gap is a difference between the close and the open. Sometimes they're down, sometimes they're up. Okay. Here's Peloton. Love the Peloton. This has been falling. We did a million trades in this. They were what? They were shorts. Stock closed here. This is tanked. Look at this. This closed up here. This is back at the beginning of November. This was an earnings gap. Closed up here over 80. Open in the morning where? 50. This is terrible, terrible, terrible. This is a big gap down in Peloton. So we shorted this. It worked, and you could have done an option 2, which you would have wanted to do a put, which is a short, and it worked, and it fell. Boom. And this is still falling, actually. So this was just yesterday. Look at that. So before the earnings, this was in the 80s. This has lost more than half its value, more than 50% of its value just in the last month and a half since the earnings. So this is the power of the gap. Okay, again, how do you make money in the market? You got to go with what's happening in the directional buys. You got to get the direction right. So that's the only way you can make money. If you're going long the market today, you're down. If you shorted the market today, you're up. So you have to think logically. Why do gaps work so well to trade? Why do they work so well? They have big moves. Here was IBM. We did this back in October. Huge move, plus the ones I just showed you before. So big moves. That's how you make money as a trader. So you don't have to take 10,000 shares or something. Again, because you still need cash to do that, whether it's a margin or not. You can get thousands of dollars in profit if you get something that moves $5, $10, $20, big moves. That's what you want to do. You also get fast moves and gaps. Quick, we're in, we're out, we're in, we're out. In an option, it could be 24 to 48 hours. In a day trade, it could be 5, 10, 15 minutes, could be half an hour. But fast means quick, quick, quick. Because remember, the longer you're in the market, the longer you're in trades, the more you're at risk. Even if you're out, but the trade could turn against you. So, in this type of environment, which my outlook for 2022, I don't want to get too much into this. I will talk about this today on Chatter. The whole thing about 2022 is I think it is going to be more volatile than 2021. 2021, really, when you look at the whole year, was a strong year for the market. You could have gone long crap stocks and made money, actually, stocks and downtrends, whatever. You could have gone long a lot of things, made money, because the market really just had such a big move up in the year of 2021. I do not think 2022 turns out to be the same thing. And so far, it's not even just 2 days into the year, quite frankly, or 3 days into the year. But gaps set up often, and that's the other reason to trade them. You need them to set up often to what? To make money. You can't have a strategy that only sets up 3 times a month, once a week or something. You need consistent setups to make money. So who makes gaps? Who is creating those trades we talked about in the post-market, in the pre-market? Institutions, institutional money, hedge funds, big traders, big money people that take positions on, they take positions off. They are creating the actual gap. That is why it's so important to read that and see what's happening. Is the buying coming in? Is the selling coming in? Who's in control? Who's in control right now today in a stock like Peloton, just because we just talked about Peloton? The bears are in control, okay? So again, you would want to be short. You would not want to be long. You have to go with the control of the control level, because you personally are not going to move a stock. And even my entire trading room, if we take the same position, we're not going to move a stock. It's millions and millions and millions of shares and movement, big positions, big institutional money that moves stocks and moves the market. Now, here's something we did when we were talking about options and stuff. We did an option in Tesla. It's very expensive. It worked. We went long. We did a call. Here is a gap up. So this closed here at 105,678. This was New Year's Eve. And then on Monday morning, the 3rd, it opened at 114,775. We did an option. We did a call. It went to the target. It was 1,200. You could have bought it, got in, got out. Boom. But this is a gap. This is a gap up. Okay. So again, I don't know that this is going to happen on Friday. I didn't take a trade here Friday. I took a trade here Monday. You understand what I'm saying? So my strategy plays the gap itself on the gap day. I'm not predicting this. This very well could have gone the opposite direction, COVID, whatever else. I wait for the gap. Then I have a system where I rate it to determine, is this going to get bought or is this going to get sold off? And in this case here, I rated it. It was a long, we did it, it worked. Somebody's asking about Tesla. Because I'm explaining to you here. How did I know to buy calls in Tesla? One, it gapped up. I got up in the morning, I scanned, I saw it. I said, wait a minute, let me look at this thing right here. Again, this was Monday the 3rd. I have a system. This is my strategy. And I go through 26 points to rate it. If the stock rates 20 points or more per my 26-point system, I take the gap. the stock, the market, whatever I'm looking at, I do ETFs, like the QQQs, the SPY, the diamonds, I do those too. I take it in the direction of the gap. So I'm always going in the direction of the gap, but I'm not always doing every gap up long, and I'm not always doing every gap down short. It has to rate for my system 20 points or more for the 26-point system. That is not what we're going to go over today. That is something I teach in a 2-day course that takes 16 hours. I'm showing you here just the very, very beginning concept of gaps to understand how these work a little bit, how you can make money playing momentum and direction correctly, what a gap is. The system itself, the strategy itself, it's something that I charge for my time and learning this class in the class, that if you want to take it, you can email me later and inquire for more information. But you can also come, if you want to try out the trading room this week, you can email me at melissa@thestockswoosh.com the rest of the week. And we only have Thursday and Friday, but I'm sure we'll get things to do. I'm sure we'll get things to do. And it'll be interesting to see where we open tomorrow, because remember, we got them today. I don't know where we're going to close. We've got 2 hours left, but we have 2 hours left today. So again, I'll see where we close when. 4 o'clock. 4 o'clock. At 4 o'clock, I'm going to know where we close. And then I'll go to bed tonight and I'll get up in the morning and I'll see, are we going to gap up? We're going to gap down. And I'll say this one quick thing here, even though I don't have the market up. The thing is, people love to buy dips, and people could buy this market here into 2 o'clock to 4 o'clock, 3 o'clock to 4 o'clock. I don't know. They could buy it even though we fell this morning, because people love to buy dips. I do not do that. I do not do that. And if you had $10 million right now, I'm just throwing this out there, and I'm going to go back to the lecture. If you had $10 million right now, would you buy this market right off the highs? Right off the highs with COVID, this thing, that thing? I wouldn't. You know what I'm saying? So again, I don't think this is the end of the sell-off here, but we have to wait and see. So I'm looking day by day by day. So again, day by day, get up, boom, rate it. It looks good. It's gonna rally. It's gonna get bought more, goes. And I'll tell you right now, this fell yesterday and today, but quite frankly, if the market hadn't fallen off of planning yesterday, if the market hadn't done that, this would have made a new high yesterday. But everything tends to go with the market. So you've got to read the market right. You've got to. But anyways, here is the market. Now, this was from yesterday. Here's a sell-off from yesterday. Came into support. Now, today we gapped down. We opened here, and then we started falling. Now, this was a trade from 1220. This was a day trade. This is not an option. We shorted it. The entry was 379.45. I'm going to pull up the 1 minute. We did it on the 1 minute chart. 1,200 shares was 26.40 risk. Exit was 377.90. Remember we were talking about big moves? Remember we were talking about momentum? This is a good move. This is a big move. $1, $2, whatever you can squeeze out of it. Profit was 1,860. Now here is the 1 minute. So here is the gap. This is a 1 minute chart. Closed here, gap down. This was 1220. Pull up your own charts and look at it if you want. Open, drop, rallying, shorted it, got the drop. Here's a sell-off, boom, down, do it. So people were trying to buy this here, and we were short. I got the direction right. This was 1220. Let me go back to the daily. Here was the 1220. We closed here. We gapped down. This little taily thing is the trade that we did. And we made money. And that doesn't look like much, but it was profit. Okay. 1220, we also shorted the SPY. This had a bigger tail. Closed here, gap down, fell, boom. Okay. Again, this is 1220. We did a short in the SPY. Again, you could have done a put in this because it's a little bit pricey. 453.95, 2,000 shares. Risk was 2,700. It's an advanced risk. We did an ad because I love this. I'll show you the 1 minute in a minute. 4,000 shares, 453.75 average price. I mean, look at this move, 451.60. So again, $2, $3, gorgeous move. Size, add, boom. And I also use stops. Okay, so we had the move. Closed here, gap down. This is the SPY now. We're on the SPY, 1220, same day we did the Qs. We had 2 gap downs in the market. We got in, we shorted it, get the drop, boom, get the drop, 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 drop. And I love this, so we did the ad. And it was just a nice trade. So again, I'm in and out of day trades pretty much quickly, usually in the morning. Try to get out of them no later than, lunch. I'm not going to kill something if it's still going. An option I may do and get out the same day if it goes like Tesla, but if something doesn't go the exact day I call it, then I'll hold it until it goes, okay? Like we did some options trades today that are out until next Friday. Next Friday. If they don't go today by 4, I'm gonna stay with the trades, okay? Again, momentum, okay? So you can day trade gaps or you can do options and gaps. The nice thing about options is you don't need margin. You can open up an options account with $2,000. You are not risking $2,000 in the whole trade. You would risk 100, 400, 500, something like that. But you can open up a cash account with only $2,000. So a lot of people like to do options who don't have the wherewithal or the finances to open up a margin account. So that's your choice. That's your decision. It's the same strategy, the same system that I'm doing it. Now, I'm just going to show you some options trades we did do here. This was falling today. I don't know if this is where this is at right now. This did gap down today with the market. This is the daily chart of Amazon. We did a bunch of trades in this. Somebody's asked a question here. Let me look. How do I decide each entry and each day trade for that gap? Well, again, I have to wait. I have to watch it. I have to see the setup. I'm not going into anything in the pre-market. I don't trade the pre-market. I don't trade the parse market. I don't predict the gap itself. This is live trading. And again, if you'd like a trial of the trading room, email me at melissa@thestockswoosh.com. You can come tomorrow. I call the trades live. I say, don't take it here, put the stop, here's the target, we're in. This is live. I have to watch it. I'm not getting in trades at 8 o'clock in the morning. I'm doing the analysis. The analysis when I get up 6 a.m., 7 a.m., 8 o'clock, right up until 9:30, I decide I like this today. I'm doing Amazon today, whatever I'm doing. I don't know where I'm getting in until it opens and trades live. I have to think fast on my feet, but I am calling the trades if you're in the room, and you do it when I call it. The easy thing about following me, though, is that I only usually do one thing at a time. Now, that particular day in 1220, we did do 2 things because the market, there was 2 things. So I knew the market was going to fall, so we did 2 market trades. You could have done 1. Again, we usually do 1, but, you know, I don't think it's hard to follow me because of the fact that I usually focus on 1 thing at a time. If you're interested in a referral for a broker or want to know where you could talk to someone, you can email me. If you want to know, you don't have to trade where I trade. You can really go anywhere. But if you want a referral, just email me at melissa@thestockswoosh.com. I don't have any affiliation with any brokers, though. You should know that. So you're not going to get any special deals, even if I refer you to my place. So that's really up to you. I think the interesting thing about trading right now with brokers is years and years ago when I started out, 2008, I mean, there were fees. We paid platform fees. We paid commissions. We paid all kinds of fees. Things have changed now. So you may not want to trade where I'm trading. You may be able to get a better deal someplace else because a lot of places, because of competition, because of the way that some of these places have gone together and merged, like Ameritrade bought Charles Schwab, they're not charging fees. But I personally like service. So I'm at a place with service myself. So it's really up to you. Also, I've been using the same charting package since I started trading, which again was 2008. I don't want to change places, but that's just personal preference. That has nothing specifically to do with the broker. You have to do what's best for you, what's cost effective, because if you have a small account, $2,000, then you're not going to want to pay a platform fee. It's going to eat up your cash, okay? So let's look here at the option in Amazon. We did the puts, 12.9 I called, this expired 12.17. I'll show you the gap in a minute. This wasn't cheap, but to pay one $35 fee for 1 contract actually is cheap when you look at the price of Amazon. So you see what I'm saying? You would have never spent $3,500 or $7,000 or whatever to buy or to short this on margin. So let's go back here. Thursday, the 9th. Here. So this closed here, this gap down, I called the short, which was a put. This is an options newsletter service. That was the gap. So I called the 34.50s. You see where we are. Take it to the right. Called it a little bit under the price of the open. And then you see the drop. Boom. It was a put. It was a great trade. It was a 300% return on investment. Again, just a nice call and very expensive to trade. So we did it as an option. If you wanted to buy one, you still could have made $10,500 risking $3,500. That's a nice trade. You've got to have the cash to do this. You can't take a half a contract, but you know, we do some of these high flyers. We also did an option, the SPY. Here's the daily in the SPY. This day was the 17th. 460 puts we did, expired on 12/23. I'll show you the move. This was more reasonable. 475, sold it at a 950, 100% return on investment. And then if you did the intermediate trader, you could have made 1450, risking 1450. Let's look at the gap. So December 17th. So how did this work? Why did it work? How did it go? How is this a profitable trade? Because I called it here, fell, boom, dropped into the gap and fell. Do you see? So I called this on this day here when this gap down. Then we got in it. Then it continued. This is the move. This is the profit. This is the money. Boom. Okay. That was a nice trade. So again, that was on the 17th. Anyway, returns can be great for gaps. You've got to pick the right one. You've got to pick the right one. It's a kind of thing, but of course you can make money doing this. It's just a lot of people just tend to, they're all over the place. I don't know why. I think everybody wants this magical thing they're never going to have a day where they don't lose. That's not true. I have trades that don't work. I just showed you November. We had a great month, but I still had trades that lost. So, I mean, you have to have a set risk amount. You can't like risk your whole account in one trade or whatever it is. And you really have to be consistent with what you're doing. I have conviction. I talk about this a lot. I talk about this in my teaching. It's very important. I have conviction in what? The institutional money, the buying, the selling, what's going on, who's doing what. You got to remember, day trading isn't investing. That's why I said I don't buy the dip. And if I had $100 million or managed a fund, I wouldn't buy this at this placement right now in this market. I would not do it. And I don't think other funds are going to do it either. So even if we rally today, I don't think it holds. But again, we can look at the market at the end here when I'm done. We're in, we're out. I call it chunking it out, chunk it, chunk it, chunk it, chunk it. So you make 500, 500, 500, 1,000, 1,000, 1,000. That's how you put a week together. That's how you put a month together. That's how you put a year together. Okay, I have to look, like kind of have to just look at it like today we're doing this. Don't worry about tomorrow. Don't worry about next week. Don't worry about the trades you did last year that you lost or whatever you did last year. Think about right now what you're doing. It's the focus. Pick one strategy, one thing that you're focusing on. That is so critical. And I do think this is the reason I'm successful, because I try to narrow it down. My focus is gaps, okay? Pinpointing like a bullet, trying to hit a bullet right into it. Someone's asking about institutional money. Just curious why I use that illustration of footsteps, because it's big, big money, like big footsteps, like a bear that goes through the woods or something. It's like a big animal. That's why. That's a funny question, but that's true. I try to use illustrations to try to teach what I'm trying to say and visuals, because you know that helps people learn and understand. I think I do a good job of explaining things, at least in the class and when I'm in the room, but you know, I do the best I can in 45 minutes here. But gaps really tell you everything you need to know how to trade. Sizing is different because the stops are different, but you have to have the risk the same. And again, say you want to make 200, 250 grand a year. Again, break it down, chunk it out, chunk it out, chunk it. Okay, 5 grand a week, 1,000 a day. That's how you can sometimes wrap your head around what you can do to accomplish your goals or achieve your goals. It's never about getting everything to a piggy target. You know, that Tesla was a good trade. It did not go to the piggy target. It went to the target. The target was 1,200. That was it. And if you stayed in it too long, you lost if you were a piggy. So you see what I'm saying? It's chunk it, chunk it, chunk it, chunk it. Tomorrow we'll do another trade. Tomorrow we'll do it. Friday we'll do a different trade. It's every single solitary day. Oh, you're learning a lot today? Okay, good. That's very good. Anyways, focus on volatility. We're seeing that now in the market, just at the beginning. And again, financial freedom. You know, I talk about this on TV a lot, mostly the political channels I'm on, not just the market channels, but I'm sure I'll talk about this today on Cheddar TV about inflation. Everything is going up. Real estate's going up. Gas prices are going up. Food's going up. I disagree with Fed Chairman Powell that this is a temporary inflation. He said that all year. He was wrong. Now he says we're going to be back to normal inflation levels around 2% 12 months from now. I think he's wrong about that too. Why do I think he's wrong about that? For the same reason that we've been in the situation for the last 12 to 18 months. We don't have enough people working. We still have people working from home. We still have people that are home because of COVID, whether they're afraid of COVID or whatever else it is. And we don't have enough people to manufacture the products and services and goods and things that we need to get them around in order to have things be at normal. I talked to a person last night, actually. She runs a construction business, or would they go and they do work like, you know, fixer upper things in people's homes and stuff like that. I said, well, you should be busy now. You should be doing great. She said, it takes forever to get copper pipe. The price has gone up. It takes months now to get copper. Everything's going up. We can't get the stuff we need. So they can't do the jobs until they get the supplies. It takes forever to get the supplies. Like my mother ordered furniture over the summer, supposed to come in December. She still doesn't have it. She ordered furniture for the family room. Still doesn't have it. And again, everybody wants to be paid up front now before they even place the order for the furniture or whatever. It's just, it's crazy. It's absolutely insane. That is why costs are up. And that's not going to go back to normal till people are back at work. So the economy is going to be in a situation where prices are higher because of this situation until people go back to work. So it is a problem. And I don't know how we're going to get out of it, really. I really don't. Minimum volume, I typically want to see things that are companies you would know. Apple, Peloton, we talked about in Boeing. I'm not going to trade low float stocks under $1. I want a couple million shares. I mean, I don't want a little dinky rinker dinker. So it's just companies that you know, and they've got to trade, they've got to move, they've got to have millions of shares in them. I don't have a set amount where I won't do anything under a set amount, but it's like, I'm not going to do penny stocks. I'm not going to do something that costs $1. And those stocks don't have the volume. And if they have the volume, it's like one day in a month or something. Anyways, getting back to what I was saying, you can do this if you learn what to do. And if you follow someone that knows what they're doing. It's not a fairy tale. You've got to be realistic though. What do I mean? It could take you time to learn what I know. You might learn it in a weekend during the class, or it might take a couple of days or a couple of weeks or a couple of months. You may not understand everything right away. So you may have questions. You may have to start out with a small account. Everybody wants to say, oh, I want to start out with a big account and take the Amazons. If you have $10,000, then that's it. If you have $5,000, that's it. Be realistic. Set goals for yourself so that you can get somewhere. So if you are still in your head like, oh my God, this is crazy. It's not crazy. People are doing very well with me. I've had a business now for 10 years. 2012, I started the business. It's 2022. I can't believe it's 2022, by the way. But anyways, you can do this, but you have to be realistic. But that's not bad. You're going to get to your goal farther and faster and feel a lot better about yourself if you're more realistic. Because if you're living in fantasy world, that you're going to make all the money you've lost in the past trading in one day or 1 week or one trade or something like that, or risk your whole account, or like that's what people are thinking about that GME stock. I know, like if you think that somebody's going to make you rich and like look at a split, like it's like gambling or something, this isn't for you. Be realistic. Know that there's an investment. You have to pay for my class. You have to put in the time. You have to ask questions. You have to get up in the morning early. I'm up every morning by 6 a.m. I'm looking at the market. You have to open a trading account. You have to set up the platform. You got to learn the charts. Does it mean it has to take you forever? No, but there is a commitment level. So that's the reality. There's a difference between fairy tales and achieving goals. And of course, everyone talks about January. Everybody has, you know, everybody goes on a diet and everybody has exercise goals and everything like that. You can call it a New Year's resolution. You can call it a goal. I think goals are a better word for it, because you say New Year's resolution, then you feel bad if you don't do it. Say a goal, okay? You say by February 1st, you know, I want to be doing this or whatever. I want to have a trading account. I want to be trading gaps. I want to make this much money a day. You know, be normal with setting your goals. Someone asked a question here. Let me go back. What's the minimum maximum percent gap mode? I actually do not look at the gaps based on percentage. So that is not a factor for me. I will do gaps that are all over the place. We talked about some earlier. I will do little ones. I will do big ones. I don't have a minimum or a maximum, to be honest with you, because I look at many, many things in the chart, not just the size of it or the percentage. So anything's game for me as far as that goes with the gap move. Risking money may be hard, but everything has a cost. Again, your dreams are achievable with time, money, and work. You can do it, and it becomes easier over time, because the better you get, the more money you're going to make, and then the better you're going to do, and then your confidence is increased. But again, you have to think of it as a long-term process, not that it's going to take you forever, but that you're chunking it out and you build up your account over time. I think the time and effort to trade is worthwhile right now because of the economy. Even if you're working from home, even if you have another job, even if you're doing something else full time, you can make extra money on the side, even if you still want to keep your job trading. And if you want to do this full time, it's a nice income, and the better you get, the more money you have, the more you can risk over time and do some of these bigger trades. But it's a short time each day, which is a positive thing. Now, what do I teach in the class? It's a 26-point checklist. It measures gaps by rating them in the daily chart to find stocks that have, number one, a high probability of directional bias for the entire day. 2, a big move on the day. 3, early confirmation of the bias in the move between 9:30 and 10. Precise entries with follow through, and a good risk to reward target potential. So that's what I'm looking for. Again, it's about chunking it out. If you come to me and take my class, you will learn a 26-point professional bearish gap rating system. Purpose of the system is to find which gap to help you trade each day using the checklist. This is all I use. Nothing else. I don't even look at fundamentals, to be honest with you. So the class is called the Golden Gap Course. The next class is in a couple of weeks, the end of the month, January 29th and 30th. If you have time to think about if you want to do it. Class is online. Class tuition is $69.99. You must email me for sign-up forms. And again, it's online. You can be anywhere in the world and take it. Remember, education is a gift to yourself. It's an investment in yourself. Like anything else you would want to do, like if you want to lose weight and you want to buy a Peloton, it's an investment. I bought one of those red lights last year. It was expensive. Great investment. And in fact, I'm thinking about buying another one now because they're doing a sale. They're doing a New Year's sale. It's one of those ultraviolet lights I've been putting on my face. My skin looks amazing. I have to do it every day for 10 minutes, but like my skin looks fabulous doing it. It was like the best investment I ever made. I spent $1,000 on this light, but you got to do it every day for 10 minutes. Everything that you want to like do something to help yourself, whether it's your finances, whether it's your health, whether it's your mental state, your emotional state, you know, we really have to take care of ourselves right now. Look at what's happening in the world. Like it's just, if you don't take care of yourself right now, I mean, you can really get sucked into some terrible negativity because the world is crazy. It's just crazy right now. And I don't know when it's going to get any better. Anyways, if you want to sign up for the options newsletter, this is $69.99 a year. I do have a half-year annual subscription, which is $49.99 for 6 months. If you're interested in that, email me. And one quick special I'm offering everybody here today, and this is only through Friday because I'm doing this for the New Year's Eve. If you want to sign up, you have to sign up by Friday, but you want to do a trial, you can email me at melissa@swoosh.com. Deadline is Friday. You get the trading room free for 1 year with the class, but you have to sign up, pay by Friday. You do the class at the end of the month. And then the options newsletter special for the New Year's Eve sale is $59.99. You'd save $1,000, and you can sign up for that too, and you get the Gap Options course free. Let me just see here. Something about subscribers can open an account with the signals being executed. Well, you get the options newsletters are sent to your email. You have to be able to open your email. So I don't know what you mean by that. If you don't have access to your email or to your trading account to place the trades, I don't know how you're going to place them. Now, most of the options trades are sent in the morning. Now, I just want a quick look at what's going on right here quickly. Can everybody see the chart? I know I only have 1 more minute. Let's just quick look at this market right here. Oh, I call puts in the queues. They're working. Wow. We did this today. We did this. And we did this. Everything's working. Wow. Okay. Any quick questions? If not, I'm going to make myself look beautiful for Cheddar at 4 o'clock. Thank you, Sherry. Thank you.
Oh, thank you.
Thank you.
There's a few questions here for you.
Oh, okay.
And I'm going to suggest everybody who has a question, you take advantage, email Melissa, ask the question. Oh, somebody said what you do is incredible, amazing trading from Harry.
Oh, thank you.
And Tam, I'm not even going to try to say your whole name. Do you have an understanding with your broker where your subscribers can open an account with the signals being executed on the account by the broker on behalf of a full-time worker?
No, I do not. I do not. That's what I'm saying. You have to be able to do the trade yourself. You have to be able to place the trade.
That's why you want to join and talk to Melissa. And Chris wants to know, what's the min/max percent gap move for average trades?
I don't have any minimum or maximum. I look at everything differently. I'll do baby ones. I'll do big ones. I look at I look at 26 things. So that's not something that I really have an answer for, because it's not like that easy.
All right. Well, that's everything else. I think people have to send you an email about.
Thank you.
I see Norma said this is a very dynamic presentation. I'm learning a lot. This is fantastic. And Norma, make sure you email her. And also, David, we are recording this. You'll get an email from GoToWebinar about it so that you can see it right away. And then we also download it, put it on our YouTube channel, and we let you know that it is there at tradersexclusive.com/archived_webinars. I'm going to show you guys that in a second. Melissa, I really appreciate you being here. I do. And I'm looking forward to it again.
Thanks. Have a good day, everybody.
Have a good day. Bye-bye now. All right, guys. Today we had a cancellation at the last minute. So our last speaker is coming up right now. And Ricky Cadden of Real Life Trading Australia had to get up at the crack of dawn to be with us. He's in Australia. And he's going to be talking about LEAP, Leap Your Way into Maximum Profit. And he is, let's just see, let me get this out of the way. There we go. He's a full-time professional stock and options trader, trading educator, and life enricher. Ricky focuses predominantly on day trading weekly options, swing trading, and long-term option hedging strategies to help leverage smaller sized accounts and build generational wealth. These strategies, coupled with his exceptional ability to analyze candlestick patterns, trends, and market sentiment, it gives Ricky the greatest advantage to capitalize on any phase of the market. So this has earned him the nickname Australia's #1 options trader throughout the global real life trading community. Ricky, I really appreciate you being here. I appreciate you getting up early. Maybe you get up at 5 o'clock in the morning, I don't know, but we really sincerely appreciate it. You are self-muted, so if you want to unmute yourself, I'm going to make you the presenter now. And I want to know, do you like to take the questions on the fly? Do you ask your audience questions, or do you prefer to wait till the end of your presentation?
Can you hear me all right?
I can hear you now.
Perfect. Yeah, that's fine. If you guys want to ask questions throughout the presentation, that's entirely up to you. But I can wait until the end as well. So if you want to save your questions to the end, we can. I'll just share my screen here. Make sure I've got the right screen up. Which screen can you guys see?
I see.
Can you guys see the presentation? Desktop?
Well, what we can see is your slide presentation, like the slides are all down the left, so I don't think you're in actual slideshow mode yet.
Perfect.
There you go, present.
All right, no worries.
Yes, perfect.
Perfect, guys. Strap in. This is going to be a phenomenal webinar because not only am I going to give you a strategy for free, you guys will also be able to learn how to do these particular strategies on my website for free as well. And I'll save all that till the end, but
hey, I got to tell you, you're already getting kudos here. Ricky money. Is the legend. Ricky, looking forward to this with you. Good day, mate. Leap your way.
I'm trying to see the chat here.
Okay, so
Where's
you're going to
the-
want to open your questions pane. That's where you'll see everyone. And you know what I usually do? I'll sort it so that the thing that came in most recently is at the top.
Gotcha. Okay, gotcha. Right. Leap your way. Just make this full screen.
Take it away. I'm going to mute myself and let you have the floor.
No worries. So guys, thanks for being here, first of all. Also, type in a 1 if you guys have never traded options before. I want to see who's actually never traded options, who's never had any experience with options. I'd really love to see who I'm working with here. Because if you've never traded options before, they have been known as the Ferrari of the stock market. And if you guys have driven a Hyundai XL before, or a really slow car, and the first thing that you do is say, you know what, I want to drive a Ferrari, it's going to be a pretty scary event if you don't understand the moving parts and how they work. So the good thing is, in this webinar, I'm going to teach you a little bit about what options are, and you're going to understand them a little bit more, but also you're going to have a strategy to take away to implement as of today. So I have titled this presentation Leap Your Way into Maximum Profit, because leaps are an actual strategy. So let's dive in, guys. Just a small disclaimer. Options do involve substantial risk, and they aren't suitable for all investors. You'll learn about this over time. Options are a little bit different to shares, right? Options are contracts. They have expiration periods. So if your contract expires and goes to zero, you can lose your entire investment. So make sure you aren't trading money or investing money that you can't afford to lose. And I highly, highly recommend do not put your entire account on an option, because if it goes south and you do not protect yourself on the downside, you can lose a lot of money. So small disclaimer, guys, this is just for informational purposes only, but you definitely will learn a lot through this webinar. So a little bit about me. I am the co-founder and CEO of Real Life Trading Australia. Now, I have been investing in the stock market for over 7 years. Previous to this, I was a qualified electrician and I was working in the mines. Now, I'm not sure if you guys know much about the mining industry, but you know, it takes a lot of your time. You're doing 12-hour days, and I did this for 7 years. I think it was actually almost 8 years. And whilst I was away, I was working with a whole bunch of different people, and you know, some people have been there for 20 years, and I'm like, there's got to be a better way. You make all this money, right? Why are you still working? So in this process, whilst I was working away, after working 12-hour days, I really wanted to try and find a new way to make money. And I did get introduced into real estate for one, and then I got introduced to the stock market. And I had some trial and errors, but throughout that process, I started to dive into options. And from that, guys, it only took me a couple of years. Once you understand this stuff, it is absolutely life-changing. I am a full-time trader for 4 years. I have helped coach, interacted, and mentored over thousands of people globally. And now I basically just spend time doing the things that I enjoy, and I teach others to reach their goals as well. Now, I am part of Real Life Trading over in the US, right? I was coached and mentored by the greatest stock market educator on the planet, Jeremy Alexander Newsom. He is the CEO of Real Life Trading. You guys probably know him if this is not your first time being with Traders Exclusive. But he's absolutely phenomenal. And I am known as Australia's #1 options trader because it is very rare here in Australia with options. So that's a little bit about me. How will this new skill change your life, right? It's going to give you freedom, choices. You're going to learn how to create yourself extra sources of income. You can use it to pay off credit cards. save for another investment property, pay off bills, and invest in your future. Now, when I say invest in your future, guys, does not necessarily mean money, right? You want to invest in yourself. There have been so many opportunities over the last 18 months during this whole COVID period where you could have taken a very, very small chunk of money with an option and possibly turned to retirement early. In fact, 5 of my traders have now retired 5 years earlier, which is absolutely amazing. Just by using a very simple strategy like I'm going to give you today. So make sure you guys do invest in yourself, invest in your knowledge, invest in your future. Now, why should you guys listen to me? Well, this information that I'm going to give you is entirely free. It is going to give you a strategy. I'm not going to sell this to you. I'm just going to give you the entire strategy. You can start making money tomorrow. Now, our mission at Real Life Trading is to enrich lives. So if I do enrich your life and if I do teach you something new tonight, I would really love to hear from you guys. Send me an email, send me a text message, whatever it is. I would really love to just hear from you guys and just extend that gratitude just for having you here watching this presentation. Now, there's a few things that I need you guys to focus on when it comes to trading options, right? I mentioned before, it is like the Ferrari of the stock market, right? Trading is not for the faint-hearted. It carries risks, right? Although it can be managed safely. Like I said before, if you jump into a Ferrari, you've never driven a car before, you probably crash the car, right? And I don't want you to crash. So I have specific risk measurements in place for this particular strategy that I'm going to give you so that doesn't happen to you. So make sure you do follow the rules. Also, don't over leverage yourself. I did mention that you don't want to put your entire account on this particular strategy, right? Start small. That's the beauty of options. You can control a massive amount of shares with a very small capital outlay. Also, go and do the free courses on our website. I'll give you guys the website at the end of the presentation, and practice this with paper money first until you understand how it works. Now, there's a few myths and traps, guys. First myth that I've heard many, many times is trading is gambling, right? Trading is gambling and you need tens of thousands of dollars to make money in the stock market. Now, I've been trading for quite some time. You definitely do not need tens of thousands of dollars. There's a lot of people out there that sell. There's a lot of people out there that sell courses that you have to pay tens of thousands of dollars to do, and then you end up having no money left to actually trade with, right? You don't need to have tens of thousands of dollars to make money. You can leverage your capital. And you're going to learn about that in this webinar as well. Now, the difference between trading and gambling, in my opinion, right? If you are at a blackjack table and you put down $10 on the table to play the game and you get dealt your cards, you can't then take away your $10 or even take away half of your investment because you don't like your cards. Once you put the money on the table, that's it. So if you lose your entire investment. Whereas trading, if you put your money on a particular option or a particular trade and you don't like the way that it looks, you can always take your investment back or look to lose small. So that's, in my opinion, that's the best way to look at the difference between trading and gambling. You can definitely gamble when you trade if you have no risk management strategy, right? And if you don't manage your risk and you don't have a strategy, then by all means, trading is gambling to those people. And this is the reason why 90% of traders lose money, right? Now, I actually think that is also a myth as well, because I think that only 89% of people probably 89% of people probably lose money, right? There's 10% of people that actually do good, but there's 1% of people that actually have a strategy, right? They have a strategy, they have a system that they follow, and I want you guys to be that 1%. The 1% difference in the market that takes away this old myth that trading is gambling, right? 90% of people are really bad at anything, right? I'm really bad at cricket. I cannot play cricket. I'm really bad at tennis. But if I put the time into learning how to play cricket or play tennis, right, and I learned about how to, how to hit the ball properly, I could actually be one of those 1%, right? So I really implore you to invest in yourself, invest in your education, and learn the systems in place before you crash and burn, right? Don't just jump into the Ferrari, check it out first, learn about the moving parts, practice, 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 and then you can be that 1% too. So the objectives of this webinar, guys, what are you going to learn? Now, I'm going to talk to you about what stock options are, because there are some of you I see who have never traded options, right? Some of you don't even know what leaps are. Some of you have been trading options but don't know what leaps are, right? What are the benefits of leaps? And then finally, I'm going to give you for free 10 key steps to identify leaps opportunities. Now, this is going to be life-changing for a lot of you, and it's going to be a real big mindset shift, right? Those of you who have small accounts, you are going to absolutely love this strategy because time is on your side. Now, we are not day trading, guys. This is a swing trading strategy, right? It's a swing trading strategy. So if you are currently working right now and you're trying to break away from your job, from your career, or maybe you're working too much, right? There's doctors out there working 12, 14-hour days at the moment because of COVID, right? If this relates to you, then this strategy is going to help you. Why? Because you can still work your hours and make money on the side. This can be your side hustle until you make it your full-time thing. I had to do the exact same thing when I first started upcoming as a trader, and I just want to give back to the world, give back to you guys, and give you that opportunity too. Right, so I'm just going to go through a few theories and definitions for those of you who don't know what an option is. An option is it's a contract, right? It gives an investor the right, but not the obligation, to buy or sell a stock at an agreed upon price, which is known as the strike price. Now, these contracts have an expiration date, right? They do expire. They can basically go to options heaven once they go to zero, right? There are two different types of options. I know a lot of you have heard about call options and put options. What do they mean, right? A call option increases in price as the price of the stock rises, and put options increase in price as the price of the stock falls. Now, some of you think that if you are going bearish on a stock, you have to play put options. That is incorrect. There are so many options when it comes to options, right? Pardon the pun. Right? You can be bullish on a strategy and sell a put option, right? You can be bearish on a stock and sell a call option. Just as if you wanted to go long on a stock, you can buy a call option. If you wanted to be bearish on a stock, you can buy a put option, right? So you'll learn about this as you start to trade them, which is why I can't stress enough, you guys need to practice this stuff and understand how these options work. Now, I mentioned before the strike price. What is it? The strike price is is a price where two people agree to buy or sell a price at. So for example, these are usually round figures or sometimes in 50-cent increments, right? You agree at $100, right? If you're buying or selling at $100 strike, that is between the buyer and seller. Can't change. It's not going to be 150 cents or 132 cents. It's going to be either a round number or end in a 50-cent increment for some stocks. These contracts also have an expiration date, which is just the contract when it expires. Now, just to give you guys an example, if you've never traded options before, if you are trading one contract, you are actually controlling 100 shares, right? I'll repeat that again. If you are buying or selling one contract, you are controlling 100 shares. So if you had 5 contracts, if you were to purchase 5 contracts, you are actually controlling 500 shares. Now, just to give you guys an example, if the option price is $1.60, right? It's $1.60 times 100. So one contract to control that particular option would be $160. And if you had 5 contracts, it would be $800. Now, what are LEAPs? You might ask, right? LEAPs is actually an acronym that stands for Long-Term Equity Anticipation Security, right? They are securities that are publicly traded. They're options contracts that have expiration dates that are longer than 9 months, and in some instances up to 3 years of issue. Now, as I mentioned before, you guys aren't going to be day trading LEAPs, right? This is a long-term growth strategy, and not emphasize growth, right? Because we only focus on growth stocks when it comes to LEAPs. You do not want to be trading LEAPs on penny stocks that are just slowly declining. You don't want to trade LEAPs on highly speculative options where they're just going sideways, because the longer an option goes, or the longer a stock goes sideways, an option will just decay in value, right? So you need to understand that this is a long-term growth strategy for high growth companies. Now, how are options traded? Well, as I mentioned before, you can buy a call option if you are bullish on a stock, and if you buy a put option, you are bearish on a stock, right? Also known as shorting a stock. But both call options and put options can be used in bearish and bullish markets, right? Depending on how you open the position. And it is very important that you understand what you're doing when you open that particular position, because if you open a call option by selling a call option, you are actually short that option, and you can potentially lose a lot of money if the stock goes against you, right? So just be very, very cautious with options and how you open those particular trades. Now, what's the difference between options and shares, you might think? Once again, before I said you can have a smaller capital outlay. If you've only got $5,000, right, you can quite easily double that account, right? Same if you had $100,000, it doesn't really matter. It's more about the outlay of that particular investment that you're making, right? So you can have a smaller capital outlay. They are used as hedging tools. The other difference is that you have an absence of stock owners' rights, like voting and dividends, right? So with shares, you get paid your dividends and you got the voting rights. With options, you don't have them. Another massive difference is leverage, right? You get to leverage your capital. Now, when I say leverage, the good thing about options is you're leveraging on cash. You're not leveraging on margin, right? So when you're buying an option, that is, right? When you're buying an option, you're leveraging on a cash position. It's not a margin trade, right? So this is another really, really great thing, once again, because you can use a smaller amount of capital. Now, the key trading principles for this strategy, right, is it's a long-term approach. I generally focus on US options. Here in Australia, there are Australian options, but they're not really that great. So for this presentation and for all you guys out there, most of you are probably in the US, I would be focusing on US options. So this is going to relate for a lot of you. My analysis model for this particular strategy is technical analysis, and the trading horizon is weeks to months. Now, guys, I know a lot of you want like the fast cash. You want, you want to be a millionaire by next Tuesday. Some of you, all right, you want to turn that money over. You can do that, right? You definitely can do that. But this strategy is going to just help you understand, but it's going to be a very slower process, right? Rather become a millionaire over 2 or 3 years than try to do it and then crash and burn and lose half of it by not knowing what you're doing over a few weeks, right? So use this as a way to increase your knowledge, take the time, and this will work really, really well for you guys. So without further ado, guys, I'm just going to give you guys the exact steps, right? And then we'll dive into just a couple of different examples of how this worked. And who's ready, by the way? I want to see some fives. Give me some fives. All right. Oh yeah, Justin. We got Scott, Jeff. Perfect. Thanks for being here, guys, once again. So let's do this. Bill is in the building. Wow. He has to be my #1 trader at Real Life Trading Australia. He is absolutely amazing. Uses this strategy all the time. But let's go, guys. Let's do this. 10 key steps. Now the checklist, right? You only need 7 out of 10 requirements for this, right? You don't need all 10 steps. We don't need to wait for the stars to align and get 10 out of 10. This is the beauty of this strategy. You just need 7 out of 10 of these particular check marks to make this work or play in your favor. And #1, you just need to know, is the stock in an uptrend on a weekly chart? Now, most of you who trade can look at a chart and see if it's going from bottom left to top right. You'll be able to see if it is in a weekly trend, right? That's checklist #1, right? We could teach a monkey how to do this. #2, has the stock had a 20 to 30% pullback from the recent highs? Well, that's also very, very easy as well, right? We have charting tools that can help us find percentage pullbacks. #3, is the stock bouncing off any long-term 100 or 200 simple moving average on a weekly or a daily chart? Now, I say long-term moving averages, guys, because this is a long-term strategy, right? We're not looking at the 10, the 20 EMAs or the 50 SMAs, all right? I mentioned weeks to months, and when you're playing with leaps, you're looking at 9 months plus, right? So you need to be thinking 200, 300, 400, 500 days out, right? This is the reason why I talk about long-term moving averages as opposed to shorter-term moving averages. Now, #4, has the stock had an above average volume within the last month, right? I'll show you this on the chart a little bit later on. Has the stock created a higher high and higher low in the last month? #6, now the good thing about these last 5 check marks, guys, is the items from 6 to 10 can all be done with a stock scanner that we use called FinViz. A lot of you may be aware of that company or the website. Go and check it out. It's entirely free. By the way, feel free to take a screenshot of this particular strategy and go and test it out for yourself. All right, you guys can have this. So #6, is the stock trading above the 200 simple moving average on a daily chart? Once again, bang the 200 simple moving average on your chart and see if the stock is trading above. You want it to be above simply because if it was below the longer term trend, the longer term moving averages, there is a possibility it will probably trade sideways and or reverse and go lower. Now, number 7 is the RSI indicator trading below 50. Now, what is the RSI? The RSI is a relative strength indicator that has a range between 0 and 100. Usually the highs and lows are between 30 and 70, 70 being overbought conditions and 30 being oversold conditions. Now, is the RSI indicator trading below 50? Basically, what that means is if the RSI was at 70 and we're in an overbought position, you're most likely going to expect the market to pull back and go a little bit lower, right? You want to be buying at a low point with this particular strategy, or buying the dip, right? So if we can get below 50, even if we can get back down to the 30 level on the RSI, that would be even better. Is the company's sales growth quarter on quarter greater than 20%? Now I'll show you what this means, and well, actually I'll tell you what this means, right? The reason why we want sales growth quarter on quarter to be greater than 20%, very, very simple answer. We want to make sure that the company is growing more than 20%. Very simple, right? Quarter on quarter. We want to make sure it's consistently growing more than 20%. We want to make sure that the company is growing every single year, right? We don't want to have a company that is, you know, it looks like it's growing on a chart, but their sales are actually declining, right? Because we want to make sure that the company is growing. We want to make sure that our investment is going to grow as well. Now, number 9, does the stock have an average daily volume of more than 1 million shares? And that's quite simple, guys. You know, you want to make sure that the stock is liquid, but also you want to make sure that the options are liquid as well. You don't want to be trading with penny stocks. You don't want to be trading leaps and options with penny stocks, because they're hard to get out of once you are in them, and you end up getting a really, really bad fill price. And lastly, is the stock trading above $20? Now I say $20, guys, because you don't have to trade the large cap stocks, right? There are a lot of big companies out there that trade for, you know, $30, $40, $50. The large cap stocks are definitely better to trade with, especially on this strategy. But you know, just don't focus on anything lower than $20, because usually they're not high growth companies. So let's have a look at the screener, right? So when we're screening for leaps, this particular screening page is just a small screenshot that I took off FinViz. And as you guys can see here, all the little yellow highlights, you know, these are part of our screening process, right, that I had before in our little checklist. So is the price over $20? Is it 200 simple day moving average? Are we trading above that? Is the average volume over 1 million? You know, relative volume. Now I say over 1 is because I want it to be basically over the average, right? And the RSI not overbought, so it's less than 50. We want to make sure that the stock is optionable and shortable. And then once again, our sales growth quarter on quarter over 20%. So as you guys can see here, this is only a very small screenshot, right? As you guys can see, just at a quick glance, all these stocks are trending from bottom left to top right. Right, so we already know that we're in an uptrend. Some of the stocks are pulling back, right? And this is what we want. We want the stocks to be pulling back because we want to be buying a dip, right? We don't want to be buying at an all-time high level. So just keep that in mind, guys. There are lots of stocks and lots of companies out there that will show up. Once again, you're just going to have to go through your screening process as well. Find which one works for you. Find which ones have the best options with very, very tight spreads, and then go from there. But here's just a small example. Now, this is on Square. Right now, I know that the price has probably definitely changed since I last took this particular picture, but just notice, right? We are in a weekly uptrend. We were in a weekly uptrend. The recent highs, right? When we came to the all-time highs, I've taken a screenshot here. As you can see here, we had a 21% pullback, right? 20 to 30% pullback. The stock price is over $20. This one at the time was trading at $158. We're above the 200 simple moving average. The above average volume, as you guys can see here, is above average, right? Our volume is trading above 1 million, right? We've got 7 million shares, we've got 8 million shares traded on that particular day. And lastly, the RSI is below 50. So what you guys can see here, just by having a small glance at this photo, back in October, right? Notice when it was at the 70 on the RSI and the stock was trading at $190 per share at that time. Notice what happens to the stock, right? It starts to decline. The last thing that you want to be doing when getting into this particular position is getting into a long-term, long call option, right? You don't want to be buying at the all-time high, right? You want to be buying on the dips. So have a look at what happened in September, right? When we kind of ducked down, we were at an all-time high at the time, at the start of September, and then we had a nice little, 20% pullback almost. We traded below 50. We created a beautiful little double bottom, neckline retest, and then we shot up from $140 all the way up to $190. So type in a 6 if you'd love to capitalize on a move. Type in a 7 if you've bought a stock at an all-time high. I'd love to know who's done that, bought at an all-time high, and then just watch the stock go against you. Yeah, I see a few 7s, right? Definitely a few people, right? We've all done it. We've all been there. And this one indicator, just by using the RSI, is going to stop you from doing that, right? Because you're not going to see the RSI trading at 30 when the stock is at an all-time high. Just not going to happen, right? So just using that one indicator, if you've never used it before, use it, throw it on your chart, and just see how it would have worked in your favor. That might be the very next starting point from going from a non-profitable trader to a profitable trader, just by analyzing the one indicator of the RSI, right? But once again, 7 check marks, right? We've got 7 check marks here on Square. Another one here is Twitter, right? So we can see like we are currently in an uptrend. Have a look at the very start of this chart back in June or just before July. We came down to the 200 simple moving average. We were pulling back, right? The RSI was roughly around 7. We pulled all the way back down to 40 or below 40 on the RSI. And then right then and there, we had this increased spike in volume. You can see the bearish volume that came in. And we ended up turning around and then trading on higher, right? So we ended up creating a nice little weekly uptrend. You could have bought the dip. You could have done this with shares. You could have done this with options. However you traded this, right? Just know that you bought at a low price. We ended up having a very nice weekly uptrend, right? We had the recent highs. Now, just before we had this dip, you can see here right at the all-time highs, we've got the recent highs, 21% pullback. We came back down to a long-term moving average. This blue line is the 100 simple moving average. Right, we had a 20 to 30% pullback. Stock is also trading above $20, right? This stock's only $48, right? So the options are quite cheap on this, especially leaps as well. But once again, it's also these are also snapshots of stocks that are high growth, right? We're trading above the 200 simple moving average. We've got above average volume in the last month, and our volume is above 1 million shares as well. You can see that we were trading at 13 million shares at the time, and our RSI is also bouncing off the 30, and we're starting to trend up, right? So we're buying on a dip, right? Where could our target be if we were in this position, right? We could wait for the stock or the RSI to trade into 70, right? Or we could wait for it to trade up into 60 or 65 or 70. Right? These levels, making sure that you're buying low and selling high, right? This particular indicator makes life so much easier, right? A lot of people have heard the term buy low, sell high, but have no idea how to do it. This is going to help you. And another one here, meeting the requirements here, is AMD. Right now, AMD is obviously not $30 anymore, but you can see we're in a weekly uptrend. The RSI, although is trading sideways, right, we're still creating higher highs and higher lows. The recent highs, right, we had a 20 to 30% pullback once again, 22% pullback. Imagine buying leaps on this option. In fact, I have an example to show you on this, right? Imagine buying leaps down at this level, right? We're above $20, above the 200 simple moving average. Average volume, we start to increase. Volume is above 1 million, and our RSI is also below 50, right? So risk mitigation. Now, at Real Life Trading, we use the R system. Now, what is an R? It is basically your risk amount of your account, right? 1R is 1% of your account. So if you have an account size of $50,000, 1R would be $500. You would only risk $500 on your account, right? If you have $5,000 in your account, you're only looking to risk $50. Now, this is the great thing about options. You don't need a lot of capital. You can set these trades up so that you aren't risking a lot of money. Practice this with paper money first until you understand how the R system works, and definitely don't do this without having a stop loss, because once again, options contracts can go straight to zero if you're not careful. Now, you do want to minimize your risk, right? Don't over leverage your account. Each open position that you have on your account, each open position will not take up more than 10% total equity, right? So if you have $50,000 worth of equity or in your trading account, do not open a position that is more than $5,000 on that particular trade. Right, so do not risk more than 1R on your trade. Your stop loss exit should be at 1R. And here is a small example of that trade example on AMD that I was mentioning before. So for example, guys, if you have an R of $500, right, this would be the trade setup. You can see here we were consolidating nice and slow. We were going sideways for a little while. We had the nice 22% pullback in the market, right? We're building pressure. This red line is the 200 simple moving average on a daily chart. Now, we wanted to take this particular trade at a breakout above these bearish candles, all right? So to do this, we would need to use a stop limit order, right? So above this candle, the call strike, as you can see here, is $29, which is roughly around our entry price, and our stop loss is down below the 200 simple moving average. So we're giving ourselves a little bit of wiggle room, right? We don't need it to bounce straight away, but we want to take this as a trade. We want to take this as a momentum trade, right? We're not getting into this particular trade on a limit, right? On a limit, on a pullback. We're waiting for this stock to start to break out and go higher. So if our entry price was $3 and our stop loss was $2, we have a risk of $1, right? Now, if you had a risk of if you only had a $100 risk, a $100 risk unit, right? That's if you had a $10,000 account, you would only buy one contract. But in this case, in this example, we've got a $500 R, right? So to work out how many contracts you need to buy, it would be $500 divided by $1, which is your risk, and it would work out to be 5 contracts, right? So it makes it very, very simple for you guys how many you should buy. Now, how did this trade work out, right? We'll show you that in a minute. But first of all, when you get into a trade, you need to understand not only where your risk or your stop losses are going to be, but you need to make sure you have a plan for when you're going to get out of the trade. You need a profit taking level on this particular trade as well. So as a general rule, when I'm looking at a risk reward, I'm looking for a 2-to-1 minimum, right? Or sorry, 1-to-2 minimum. So what I mean by that is if I'm risking $500, I want to have a profit target of $1,000 to make, to risk my 500. I want to at least double my risk. Also, if the stock has a sharp upward move of 30% more in the stock price, now I want you guys to go and have a look at a chart. And before a stock pulls back, 30% is like my magic number. I've just noticed this on a stock. It's not only when a stock is going bullish, but also if a stock is pulling back. If a stock falls more than 30%, but it's a high growth company, generally that's where the stock will start to bottom out, right? But also if it has a 30% sharp upward movement, that's generally where a stock will start to turn around or slow down, right? So it's a really good profit taking target. Also, if the RSI is trading above 70, so if we got in when the RSI was at 30 or 35 or 40, right, and all of a sudden the stock, we get into the position and the RSI is now trading at above 65, 70, 75, that's a really great time to start taking your profits as well. Also, you can manually trail your stop below recent pivot levels on the daily chart, right? So these are just ways of taking profits and managing your position. So here's that position on AMD. You guys can see here, we used the stop limit buy. We wanted to buy on momentum, right? I know the previous trader, Melissa, was talking about gaps. We ended up having a gorgeous gap right here. This would have been a trade that she took as well, right? Nice gap, nice momentum. And you can see we started to continue. Where is our profit target? Well, I mean, our profit target here, the stock price here rose 30% right to the tip, right to the tip of this candle. Not only that, have a look at the RSI, right? The RSI is trading at that time above 77. So really nice dip buying opportunity, really nice continuation, really nice trend, and the target was $7. So if you spent $3 to make $7, right, you've more than doubled your investment, right? More than doubled, which is absolutely amazing. And you'll find that when you start to do this, it is not impossible to do, especially when trading with options. So here's the example. If you have an R of $500, we had an entry at $3 and a stop loss at $2, which is a $1 risk. $500 divided by $1 is 5 contracts. Now, if you bought 5 contracts, your total investment would have been $1,500. And then when you sold the contract at $7, you would have sold the option for $3,500, right? So your profit is $4 per contract. Remember, it's $4 times 100, right? So that's $4 per contract. We have here a $2,000. It's a $2,000 difference, right? So 5 contracts times 100 times $4 equals $2,000. So your risk to reward on this particular trade was actually 1 to 4, right? Or sorry, 4 to 1. It was a 4 to 1 risk reward, right? Type in a 6 if you would love to get 4 to 1 risk reward on most trades. a lot of people, you know, they get into a trade and they don't have stop losses, and they look at this and say, I don't know where to put my target. This is going to help you. Right, so this is just one example of a trade that you could have taken. Now, guys, I do want to give you guys a special offer, right? If you guys go to this website, www.reallifetrading.com.au/passive income strategies, you are going to get 2 free option strategies. Not only that, you will also get a free dashboard. Now, on this dashboard, you'll have a bunch of free courses, your beginners, intermediate, advanced, and even day trading strategies. You'll get a whole bunch of free stuff. Go and check it out. Go and start investing in yourself and investing in your education, guys. But if you guys go to this website, I'm going to give you another 2 strategies that you can start using and making money consistently tomorrow. So make sure you guys do go check that out. Now, just trying to see a question here. Marta says, how far out are you buying the leaps? So I mentioned before, when getting into the leaps, they are 9 months or more, right? You want to be getting into these trades for a longer period of time. They're not a weekly strategy. They're not a half yearly strategy. You're looking at buying for more than 9 months. The reason why is because they're a long-term investment, right? They're a long-term trade, right? You want to have time on your hands to let the option work in your favor, right? Remember, these companies are trading above, sorry, they're growing by 20% year on year, right? So if they don't grow in the next 3 months or the next 6 months, they probably will be growing in the next 9, 12, 18 months. So guys, if you wanted to learn more about this strategy or you want to trade with me live, I do have an afternoon swing trading floor. Now this is in Australia at 7 till 8 p.m. Australian Eastern Standard Time. So a lot of you guys are in the US right now. I totally understand that. It'll be early mornings for you. But if you can't make the live webinar, you can, or you can watch the recording, and you'll be able to watch the recording before the market opens. So there is still a benefit for you guys if you are over in the States. I actually do have a few clients that are over in the States right now that do the exact same thing. Sometimes they're there live at 5 a.m. or 4 a.m. and then they watch they either watch it live or they watch the recording, 6 o'clock just before the market opens. Monday, Wednesday, and Friday, I do in-depth stock analysis. We talk about all the different strategies, a whole bunch of different swing trades that we get into. You will get these recordings sent to you via email. You'll also get access to our official swing trade log, where I do log every single trade that we place in the trading room. And obviously it's hosted by me. If you wanted to trade with me, guys, the basic bundle is $199 per month. Now this is in Australian dollars. So if you're in the US, it's going to be a little bit cheaper for you. If you want a one-on-one coaching, it is $1,000 Australian for a one-on-one coaching session with me, and I will take you through a trading plan and give you the strategy and show you all the steps how to do this in your broker as well. So you can sign up by going to reallifetrading.com.au/live trading. But this premium bundle is probably the most value out of all of them, because not only are you getting the swing trade room for an entire year, right? For an entire year, you can pay monthly at $199, or you can pay yearly for $1,000 or for $2,000. With the premium bundle, you get a yearly, you get a yearly subscription, as well as 2 bonus one-on-one coaching sessions, which is $2,000 worth of value, all for $29.97 per year, right? There's no monthly offer on this, just simply because of the coaching sessions. So take advantage of this offer, guys. It is by far the highest value, and you will absolutely love it. If you wanted to contact me, you can text trade RLT to +61 428 208 962. That is my personal mobile number. Or you can email me at ricky@reallifetrading.com. But number one, sign up to our free courses. Go and check out that website that I just gave you guys. Get the 2 free strategies, get the free dashboard, start investing in yourself. And you can also load up your custom dashboard with a whole bunch of other courses, premium courses that we do have. If you've got your phone handy, you can take a screenshot of this QR code and it'll take you straight to my website if you wanted to go and check this out. So thanks again for this this presentation. Thanks for watching. I hope you guys have learned something new. If you want to find out a little bit more about Leaps, if you want to work with me, make sure you email me, Ricky@reallifetrading. Contact me. Let's work together. And yeah, you guys absolutely rock. Now, do I have any questions? Norman says, thank you, great presentation. Amazing, you're welcome. Any questions? And thanks again, Sherry, for getting us on for this particular presentation as well.
I really appreciate you jumping in. I know that, well, I mean, do you have to get up this early every day, or are you an early morning person?
Yeah, my son gets up early. So my son, 2-year-old, you know what it's like with kids. They're up.
Oh, yeah.
They're up very,
You
very
may have
early.
been up all night if that's the case. My daughter's 2-year-old is not sleeping.
Wow. Yeah. No, definitely. I do get up around this time anyway, but it's even better I get to present to you guys. It's been a pleasure doing this for you guys.
I mean, that was a fantastic presentation, and I think that everyone is very appreciative, and I know that I put your links into the chat, so
Yep.
everybody's got the links, and I hope they took screenshots of how to get a hold of you, and I hope you'll come back again.
Definitely. I'll definitely do another presentation for you guys. I did get a question from Renee saying, where is a good place to start paper trading? Go to interactivebrokers.com. They do have a broker, and you can have a free trial and start learning with that.
Perfect.
Norman said earlier you were talking about growth stocks. Yep, so you can find out where these growth stocks are just by using FinViz and putting that into your screener. Justin says, do you sell poor man's covered calls? Definitely. I definitely do sell poor man's covered calls. They are they're just another strategy. Not part of this presentation, but I can definitely teach you how to do poor man's covered calls as well. Just going through all of these questions. Silver says, absolutely fantastic, Ricky. You're welcome. Type in a 6 if you guys learned something new. I'd love to see some 6s. I just want to see if you guys actually did learn something brand new today. That was my main purpose of this webinar. I just wanted to kind of enrich everyone's life. Great to see so many 6s. Perfect, perfect, perfect.
Awesome. How about the folks that had never done options at all? They typed in the 1s. I just wonder how they feel now.
Yeah, if you did type in a 1 before and you have never traded options, do you feel that you could possibly trade options a little bit more successfully now? Rahul says yes. Perfect. No, that's good.
Awesome.
That's good to see.
That's fantastic. All right. Well, I think that pretty much wraps everything up, doesn't it? Is there anything you want to add?
No, that's basically it. I'd love to hear from you guys, even if it's just to say thank you for the presentation. Make sure you guys email me. I'd love to get in contact with you, have a chat. I'll even give you a personal phone call myself. But let's stay in touch. Let's stay in touch. And yeah, thanks for having me.
Thank you so much. I appreciate it. Folks, we are going to have another, we'll have our next webinar on January 19th. I want to thank all my presenters today. We do have this, we post it on our YouTube channel. We'll be sending you email. All the presenters get to send you a thank you email, so you'll get more information from them probably on Friday. And this is your host, Sherry, and all of us at Traders Exclusive are saying goodbye and trade well. Thanks, everybody.